Welcome, welcome. Thank you all for joining us this morning. We will be talking through the new tax law and its impact on charitable giving today with none other than Adam Holzberg and Lauren Frary. Adam is a nonprofit partner here at Saks, and Lauren Frary is a nonprofit consultant. Again, we will save time at the end of this webinar for question and answer. We will also be sharing a recording of this webinar, which will also include the slides at the conclusion, okay? To kick us off, we do just want to get an understanding of what knowledge everyone already has of the new tax law. So we are going to launch a poll if everyone can just answer. The question is, how familiar are you with the new tax law on a scale from 1 to 5, 1 being very unfamiliar and 5 being very familiar? While you guys are quick, we've got responses filing in. Right now, it looks like most of you are very unfamiliar. So you have come to the exact right place. If we're doing percentages, it looks about 41% of you are unfamiliar, with only 4% of you being very familiar. Perfect. You guys can continue to vote, and we will go ahead and get the show on the road. Adam is going to kick us off with accounting insights on charitable giving. Adam, take us away.
All right, thank you. All right, good morning, everyone. As Bonnie mentioned, I am an audit partner here at Saks. So let's jump right into it. So, as for nonprofits, why are we talking about tax law? So, a very common question out there is always how much impact does tax law have on charitable giving? And that answer was questioned by a research study a couple years ago. Researchers at Indiana University and the University of Notre Dame did a charitable study looking at the impact of the 2017 tax law. And what they found was that there was a decline attributed to the tax law of $20 billion in that first year. So $4 billion of that was due to retiming. Essentially, people accelerated their donations to take into consideration the old tax law and take those effects in. And then there's a 16 billion permanent drop in giving due to the tax law change. And that's primarily attributed to the when we look at 2017, the change with the standard deduction and itemized deductions. So does tax law impact charitable giving? We can now say yes. So we're going to go through the different tax law changes that has either a direct or potentially indirect effect on nonprofits, specifically when it comes to charitable donations. So we split this up between individual changes for individuals, changes for corporations, specifically C corps, and then some other miscellaneous changes. So kicking off with individuals, there is one positive change here. So previously during COVID, I think it was passed under the CARES Act. There was for a few years a universal charitable deduction. It was very small. It was about $300 for individuals or $600 for married filing jointly. This deduction was essentially for anyone to take. So any non-itemizer, anyone taking the standard deduction could have taken this. So beginning in 2026, this is back. And it's actually not just back, they actually expanded it. So it's now up to $1,000 for individuals and $2,000 for married filing jointly. And just one thing to know about this is for cash donations only. So no donated goods, no donated stock, DAP contributions don't count either. This is purely for cash donations only. And this is very positive. This is supposed to be estimated this will generate 74 billion over 10 years. So this is good news from the new tax law. Unfortunately, the good news regarding the tax law is really only one slide. So now we have to go into the not so good news. So that was universal. That was for standard deduction taxpayers. So now looking at the itemized taxpayer changes. So this is going to affect for 2026. They're making permanent the 60% AGI limit on charitable deductions. So that ceiling on how much a taxpayer can deduct remains in place. And then there's two new changes, which is going to have a significant impact on charitable giving and the strategies that donors can implement. So the first one is that they're now introducing a floor on charitable giving, where itemizers can now only deduct charitable contributions that exceed 0.5% of their AGI. So how that works is if you have a donor who itemizes with an AGI of 300,000, they donate $3,000. 1,500 of that is disallowed. So they can only take a deduction of $1,500. Um, and also there's going to be a change to how much can be deducted for high income donors. So donors who are at the highest tax bracket of 37%, they will not get charitable deductions at that tax rate. It'll be capped at 35%. So these two changes are expected to have fairly negative impacts on charitable giving. It's estimated that this will reduce charitable giving by 41 to 61 billion over the next 10 years. So next slide. So this is slightly indirectly impacting nonprofits. So I mentioned before we have that new universal deduction for standards. There's some negative changes when it comes to itemize. So just talking about the SALT cap, and I bring this up because this was a major cause for a lot of back in 2017 for a lot of taxpayers who were itemizing to fall into the standard deduction. That the property taxes, state taxes were capped at 10,000. So there is a temporary raise of that cap to 40,000. It actually began in 2025, and this cap will increase by 1% annually through 2029, and then it falls back to 10,000 again in 2030. And we just bring this up because when we're looking at itemized for standard and the changes there, this can boost the number of itemized taxpayers in the short term. And then when this reverts back, you'll probably see more taxpayers again being standard deduction taxpayers. Another change is also they're introducing a new tax credit for scholarship donations beginning in 2027. So individuals are allowed to claim a tax credit of up to $1,700 for contributions to organizations providing private school scholarships. And just when we're talking about tax credits versus tax deductions, credits are usually considered much more valuable because that's a dollar for dollar reduction of your tax liability versus the charitable deductions, which reduce your taxable income, which is what your tax liability is based off of. So this will be new in 2027 for scholarship donations. So next slide. So, all right, so that was the individuals. And then I mentioned before, there's also changes to corporations, as I said, specifically C Corps. So they're making permanent the existing law where charitable contributions by corporations cannot exceed 10% of taxable income. So that remains in place. However, they are introducing a new limitation for corporations where they can now only deduct charitable contributions that exceed 1% of their taxable income. So very similar to the previous slide regarding taxpayers and that new floor. Now corporations have a similar idea, but theirs is 1%. So as an example, the corporation has taxable income of $1 million. They make a donation of $10,000. That does not exceed 1%. That is 1% of their taxable income, and that full amount will be disallowed. They will not be able to claim that deduction. There are some carry forward rules associated with this, um, but the net effect is a reduction in charitable giving, estimated at 45 billion over the next 10 years. So if you were doing the math, if you're doing math alongside me, um, that is expected to have a net reduction between the individual giving and the corporate giving, between 12 to 32 billion over the next 10 years. So in a time when we are all looking for new revenue streams, new giving from new grants, we're going to have this tax law that's also going to be hitting on charitable giving as well. It's going to result in an overall decline. So something to just keep in mind. So next slide. So some other changes. These are just some miscellaneous changes that will impact nonprofits. Um, so there's going to be the excise tax on excess compensation. So this is compensation over $1 million. It used to be capped at the top five highly compensated employees. They're removing that cap, so now this will impact all employees. They're also increasing the endowment taxes on private colleges and universities. So this will now, it used to be a flat rate. This will now scale up based on the size of the endowment. And the last one here. So during the Inflation Reduction Act, when that was passed a couple of years ago, they introduced this direct pay process for nonprofits, which made it possible for them to claim different tax credits, like such as energy credits, whereas in the past they really weren't able to. So that process remains in place. That was not touched in this tax law, so that will remain in place, as I mentioned. However, a lot of those energy credits have been reduced or eliminated. So in the future, this could be a good path to go down as you'll be able to claim these energy credits. Right now, those energy credits aren't really around anymore, but this is something down the road that this could be a net positive for nonprofits. All right, so now we kind of went through, the factual information of what changed or what didn't change based on a new tax law. Now we're going to move into how is this going to impact donor behavior? Because before we can really get into what kind of strategies you do as a nonprofit, it's good just to understand how this will impact the behavior of your donor base so you can best message to them. So you're probably going to hear a lot of this term called bunching over this next several months. That's going to be a very popular term when it comes to strategies for donors. And what that really means is where you bunch up several years of donations into 1 year. That's essentially what it means. This kind of gained some notice, I guess, back in 2017, 2018 with the new tax law, as a means to itemize for 1 year and then do the standard deduction in other years. So bunch up your charitable deductions so you can itemize, get that deduction, and then other years you don't donate and you just take the standard. So this will probably become more prevalent now simply because of that new floor and to kind of minimize the impact of that 0.5% AGI floor for individuals. So just to give an example, I mentioned before that example of, say, a taxpayer, 300,000 AGI. Let's say every year they give $3,000. So over a 3-year period, that's 9,000. However, if they do their normal behavior of 3,000 per year, that means 1,500 is disallowed per year. So the net effect would be about 4,500 would be disallowed of the 9,000 or half. Whereas if they put that 9,000 and just did it in 1 year, there'll only be a disallowed amount of 1,500, so they could deduct 7,500. So we had $3,000 increase in their deduction. Um, so that's kind of the positive of that strategy for the taxpayer, that they can maximize their donation and not get it chipped away each year by this new floor. Corporations are expected to kind of adopt the same strategy for their charitable giving. I think there was a study done that most charitable giving by corporations, it's really under that 1% threshold. So for most corporations, then if they just continue their normal behavior, they would be completely disallowed from any tax deductions for charitable giving. Um, so corporations are also expected to kind of do the same thing, bunching their charitable giving to kind of maximize their deductions. For corporations, they'll try bunch are giving years with higher taxable income, or around significant liquidity events such as sale of major assets or anything of that sort, um, to kind of get those deductions if corporate giving and charitable giving is part of their strategy. Um, so I know this is always there's mixed feelings about donor advised funds and DABs and their prevalence or growing prevalence in the nonprofit sector. However, they are here. Um, and this is probably going to be a vehicle that individuals are probably going to use more and more, especially with this new tax law. Um, with the DAF, a donor can give one amount in the 1 year and then pay it out over several years if they want to. So this kind of facilitates if a taxpayer truly wants to give a certain amount each year, they could put the full amount in 1 year, and that could be for the next several years, they could pay it out. So that could, both provide that deduction in 1 year, that bunching strategy, while still providing that similar consistent cash flow to nonprofits. So this could be the best vehicle for both sides. Donor gets their charitable deduction, they maximize it in 1 year, and nonprofits get that consistent cash flow from a donor instead of it coming in very volatile. There's also going to be an increased focus on giving non-cash assets, such as long-term appreciated securities or real estate, especially when we're talking about investments and securities. The market has been up a lot over the last year or so. So there's a lot of very appreciated stock. Um, so taxpayers can shift and give those securities, donate those securities to nonprofits, helps them avoid capital gains tax, and also can help them, supplement any cash giving. There were some changes as well with the estate and gift tax exemption. It increased to 15 million per individual or 30 million per couple. So that means fewer states will be subject to the federal estate tax. So this could potentially have impact on major gift giving and bequests by high net worth individuals when it comes to their estate planning. And the last point here is regarding qualified charitable distributions. This has been around for a while now. There's no changes from the tax law regarding these distributions, but I just want to point out because this may become even more viable strategy by donors. So what it is individuals who are aged 70 and a half or older are allowed to take distributions from their IRA and pay directly to a nonprofit. So it's a tax-free donation directly to a qualified charity. And this is important because at age 73, taxpayers are required to take minimal distributions. They have to take a certain amount out of their IRA, and that's taxable income. However, if they do this charitable distribution, that's not income to the taxpayer. On the other hand, they don't get that charitable deduction, but that's not a bad thing right now because of those limitations that are in place. regarding the AGI floor. So this could be a more popular strategy for high net worth individuals as they age up. So just those are the donor strategies that donors can now implement. They may be thinking of. They're probably talking to their tax advisors on, financial advisors on. So I'm going to now pass off to Lauren, who's going to talk more from the nonprofit side on how to best strategize around this.
Thanks, Adam. So that was a lot of great information, and I'm glad we're going to send out this deck because I'm sure people are going to kind of read through that and try to digest all of that information. But in the meantime, I'd want to talk a little bit about how nonprofits can start to kind of shift their messaging and help to inform their donors on how they can manage these tax changes, but also still meet their philanthropic goals. So let's start with the next slide, please. All right. So like in general, right, your organizational strategy is you always lead your messaging with mission and impact, right? So frame your discussions around your mission, your impact, and the value of your donor support, rather than solely talking about the tax benefits. Obviously, there's going to be some education that needs to take place, and I'm going to talk about that a little bit later. And then, if possible, you want to actually start to segment your donor communications to provide relevant information to the separate segments of your donor base. And I'm going to talk about kind of how you can do that and what some of those segments might look like. Um, Next slide, please. Again, just general strategies. Make sure that you are taking time to update all of your marketing materials, your web pages, your social media, and give information about the new tax laws and the support that you can provide to your donors and the ways that they can give to mitigate some of the negative aspects of the tax law. Also, take some time to review your corporate partnerships. As Adam mentioned, there's going to be some big changes, and possibly there's opportunities for conversations around the bunching strategies or strategies so that corporations can still meet, again, their giving goals without kind of falling into some of the pitfalls of the tax changes.
Okay, perfect. And before we dive all the way in, we do just have our third and last poll question. I will launch that for you all. Um, and this is less of a poll and just more of a single response. But if you all can just let us know who within your organization manages those donor relationships. Again, this just gives us the information we need to provide you with more materials and more information that better suits your specific circumstances. Okay, and we've got a lot of people, executive partners, we've got directors, presidents, founder, vice president, board, um, admin. So we've got a few different responses. We've got VP of development, executive director and board president, marketing director, uh, development director, partners, it's a mix of admin and board, major gifts team. Someone said, don't know their name. That's relatable. Another person said, president founder. So it looks like in the mix of organizations that we have, we've got a lot of different decision makers. So thank you all for answering that question. And let's jump into it, Lauren.
Absolutely. All right, so the new tax laws, particularly the introduction of the above the line deduction for non-itemizers, actually offers opportunities. So I always like to look at changes in tax law as opportunities for engagement, cultivation, and stewardship. Anytime there's a piece of new information, it's an opportunity for you to reach out to your donors and talk to them about this information and how you can work together again to meet their philanthropic goals. So, with regards to your messaging, you want to, as the nonprofit, you want to make sure that the tax efficiency part of your messaging is secondary. Really, the impact continues to be primary. So you want to structure your messaging around mission, what their gift makes possible, um, the optional tax context, right? How the law may support that generosity, and then choices. There's many, many different ways to give, as Adam mentioned, right? It's not just cash, it's other assets. So make sure that your donors know all of the different options in terms of how they can give. And a possible way to frame this, a possible communication might be saying something like this. These tax changes may make it easier for some donors to give in ways that align with both their financial planning and the impact they want to see, right? So think about your framing and how you can couch that with your particular donors. The other thing when you're messaging is you want to lead with education, not urgency, right? Many people are very skeptical of, kind of messaging that says, act now for tax benefits, right? So you want to avoid that. But what you do want to do is just use very plain language and explanations of what's changed, who it affects, right? The different segments of our population. So it might affect itemizers or retirees or corporations, and what didn't change so that it reduces some of the anxiety. Again, you want to avoid alarmist language, legal or accounting jargon. Leave that up to the tax professionals and over-promising on savings or tax benefits. You want to position yourself as a helpful guide, not a tax strategies. Um, the other really important thing about communication is, having multiple touches with your donors, right? So you want to avoid one single information-laden announcement, right? Have an effective mix of smaller communications to, again, target your particular donors. So you could have a short email that has a brief explanation, perhaps a one-page frequently asked questions on your website, perhaps a webinar with a CPA, maybe. Development officers mentioning in their one-on-one conversations with donors, hey, are you aware of the new tax laws and how it might affect your giving? And then a follow-up reminder during key giving seasons, right? So during your annual appeal or Giving Tuesday, just a follow-up reminder about the two new tax laws. And then I also want to talk about, and I had mentioned this earlier, when you're setting up your communications, you want to start to segment your donors. Whether you use a sophisticated donor database or an Excel spreadsheet, find a way to segment your donors so that you can customize the messaging around the tax changes for those particular donors, right? So some of your segments might be by age, so you can talk about the retirement-related provisions. Remember, Adam talked about what happens when you're 70 and a half and 73. So that would be one segment. Your giving levels, so your high-end donors versus your mid to low donors, you would have a different message for them. And I'll talk about that in a moment. Asset type, so you can segment your donors by what they give. Do they give cash? or do they give securities, or are they giving from a DAF? So that's another segment. And then business owners or corporate partners versus individuals. So think about how to segment those donors and create custom messaging for them. And then I saw that when we asked kind of who was responsible, there's a huge variety of people who are kind of engaged in your donor relations, board members and administrators and development staff. So just make sure that all of the people who are involved in donor relationships, stewardship and cultivation have the right information and the same information. You all want to speak in one voice. So, get those people who are involved together and have a short briefing about the tax laws and its effects. Give everybody the same 3 to 5 talking points and just be really clear about kind of the handoff to tax professionals if people have more technical questions about the tax laws. And here's a possible example of a messaging to people for all of the people in your organization involved, right? So you could say something like, many donors are talking about this, and we are very happy to share what we're seeing. And we always recommend confirming with your own advisor. So there's some basic tips on the messaging. So next slide. Okay. So you want to highlight gifts of appreciated assets, right? So we talked a little bit about the difference between cash donations and donations of appreciated assets. So again, educate your donors on the benefits of donating appreciated securities, real estate, and other non-cash assets. This allows them to avoid the capital gains tax and potentially deduct their fair market value of the asset. Okay, next slide. So again, discuss qualified charitable distributions. Again, here's your segment, your population, 70 and a half or up to and 73, and discuss what they might be able to do to make it count towards the required minimum distribution, and is not considered a taxable income. Okay, and then so focus on legacy and planned giving. So now is the perfect time to look at your planned giving program. And if you don't have one, now is the perfect time to think about creating one. And you really want to emphasize the value of planned gifts and leaving a lasting impact. And especially if you can provide possibly naming benefits for those large givers. I think the other thing that you want to remember is that when you start to get into planned giving, you really want to make sure that you have a gift acceptance policy. And one thing that I forgot to mention, and I'll mention right now, is along with securities and DAFs, we are seeing donors, especially younger generation donors, are giving gifts of cryptocurrency. And I know a lot of people cringe when they they hear that because it's a little scary. But cryptocurrency really could be treated the same as the donation of a stock, right? That you would take it, you would cash it in, and then you would add it either to your investments or your reserves. So make sure that you have a gift acceptance policy that is updated to reflect how you will treat non-cash items such as stock and cryptocurrency. So I think the bottom line, right, when you're talking about strategies is that it's not your job to sell the tax law, but it is your job to reduce donor confusion, increase confidence in giving, and reinforce your nonprofit as a trusted donor-centric partner.
Wonderful. Thank you so much, Lauren. Thank you as well, Adam. Great information here. And again, everyone will be receiving a copy of this webinar within a few days after its conclusion. Before we jump into our Q&A, do just want to flash up Adam's contact information. And if anyone is interested in getting in contact with our guest speaker, Lauren, we're happy to set that up for you as well.
You can feel free to email me and I can put you in touch with Lauren.
Mm-hmm.
That's no
Absolutely. And again, just thank you all for attending. And now let's jump into these questions. You guys have lots of really good questions. We also allowed our attendees to ask questions ahead of time. And one of those questions was, as a smaller organization with limited development staff, how do we manage these strategies?
So I think, I think that you want to prioritize kind of what you want to message to your donors. I think if you have a smaller staff, the best way to kind of work with some of these strategies is really concentrate on consistent messaging. So even if you can get a message out and get it into your social media, into your marketing materials, and make sure that your donors know that you are aware of the tax laws and you are very interested in speaking with them about how it might impact them and how they can continue to make an impact with your organization. If you do that one thing consistently, I think that you will still get the attention of your donors as, again, an informed donor-centric organization.
Wonderful. Our next question is, does the limitation of 0.5% of AGI apply to 1,000/2,000 deduction on top of the standard deduction?
So it's two separate things. The universal charitable deduction, that 1,000, 2,000, it's only for those who take the standard deduction. So that 0.5% AGI limit is only for those who itemize. So those who itemize, they don't receive that, we'll call the first free 1,000 or 2,000. They are on the track that's limited to the 0.5% AGI and above that deductible. So two separate things.
Okay, thank you. Got another question. Do cash donations for non-itemizers include cash, check, and credit card?
Yes.
A good question.
Next question. Could you provide, or do you have a donor-facing white paper that explains the plan changes and the benefits for our supporters?
I don't have the actual white paper. We can try to find it for you.
Okay.
We don't really have a white paper. I mean, I was giving out a one pager on the tax law changes. If you're looking for that, then you can customize it yourself for your own, based on your own marketing branding of your nonprofit. I'm happy to give you that one pager.
Perfect. Next question. When corporations bunch, are you saying that they should quit pay the bunching within that year or space it out?
So bunching means you're doing a charitable deduction all in 1 year. So you're taking, let's say, could be 3, 4, 5 years, whatever it is, several years of donations into a single year. So that essentially means the following years, there are no donations from that corporation. They're just putting all 1 year, and then the next few years, no deduction until they decide to bunch again and donate. So bunching itself means 1 year, not spacing out the payments.
And if I can add to that, when we talk about the donor advised funds, the DAFs, if you are aware of a donor who's giving you a DAF, there is a way to talk to that donor about actually putting it on as an automatic annual contribution. So that way, if the donor's life gets busy or whatever, and they forget, you can literally ask them to put it on automatic annual donation to ensure that that giving is consistent year over year and hopefully make up for some of the giving that you may not get in some years from corporations.
Okay, wonderful. Next question. How do these tax laws affect private foundations?
There's no changes to private foundations. They still have the same rules about having to distribute or grant out a percentage of their total average assets. So no changes to private foundations.
Okay, good to know. Next question. For a small organization, 1 million to 5 million, how important is it to make the tax implications available in the organization's website?
I think it's very important. I don't actually, regardless of your size, I think it's important, again, to make sure that your donors know that you're aware of the tax changes and you're willing to sit with them and discuss. And so I think that you can have just, a small space on your website or your marketing materials that even if it's like, did you know that there are new tax laws? Give us a call so we can talk about it. I think any size organization should put that information out there.
Okay. For our next question, for donors that don't have DAFs, how would you recommend working with them to have a more consistent flow of income since they'll want to bunch?
So I think that there's a couple things. If you have a giving platform, ask your donors if they would be willing to make like a monthly contribution, right? Um, and you know, think about your annual appeals and how you are couching some of your appeals and your campaigns to really promote donor engagement. Because I think in the end, what you really want to do is actually get in front of your donors and talk to them because you don't necessarily know. You might, but you might don't necessarily know who's an itemizer and who is not an itemizer. So if you can encourage your donors to have a conversation with you and get some additional information, it will help you customize kind of your cultivation efforts with those donors.
Thank you, Lauren. We have another question. Do appreciated assets count towards 0.5 of AGI for charitable contributions?
Yeah. So any type of donation, if they're itemizing, that first 0.5% is always disallowed. So whether that's a cash donation or a non-cash donated item.
Okay. And do you have sample language for either an FAQ about the new tax laws or for emails? And we actually have a few that are kind of geared towards people really want this one pager, Adam. So we might have to we may have to get that out.
All right, well, we'll work on something there. Get that out the door.
Beautiful, beautiful. We did have one person that was just asking for clarification if this presentation will be made available. And yes, it will be. We will have the recording uploaded to our YouTube and to our website within 72 hours, and it will also be emailed directly to you as well. Let me see. Do we have any other questions? I think we have. With regard to corporations, does it matter if they give through their foundation? I'm not sure.
I mean the foundation. The foundation want to get a deduction because that's be a private foundation. Um, if the question is if they're donating, the corporation is donating to the private foundation, um, that's a different set of rules where it would still be the same kind of limitations. So the foundation itself, none of this really applies. And the same rules apply for the corporations giving to anyone. But with that, though, the foundation already may have funds in there accumulated. So in that case, it will have no impact there.
Okay, and then one last question. I feel like this may have been asked just in a different way, but are corporations able to use DAFs to bunch?
Lauren, are you familiar with that?
No, I'm not actually. That's a good question.
I want to say yes, but I'm actually not sure either.
I'm not,
That's a
yeah.
good question.
So noted.
We will get back to you.
Yeah.
Absolutely. Well, thank you all for your questions. I feel like this may have been the most questions I've had, which I love because it just brings about more information and learning. But again, thank you all for registering and attending. Thank you to our wonderful speakers, Adam and Lauren. As previously stated, this presentation will be the recording of this presentation will be made available to you all within the next few days, and we'll work on those additional materials as well. Okay.
Thank
Thank you all
you.
and
Thank
enjoy the
you.
rest of your day.